Hi everyone, Kathleen here, Research Director at XTB in London. March has started on an explosive note. Stocks are a sea of red across the US and Europe as the market attempts to price in news that Trump has imposed 25% tariffs on imports from Canada and Mexico and an extra 10% tariffs on China. This has led to immediate retaliation from China and Canada and essentially means the world is in a trade war. Financial markets don't like tariffs. News that the US will impose tariffs at a level not seen since World War II has spooked markets and boosted safe havens like sovereign bonds and gold, which is edging closer to the $3,000 per ounce level. US stocks have underperformed elsewhere, and there have been steep declines, especially for tech stocks. Nvidia fell more than 7% at the start of this week. Is the decline in US stocks, especially tech, a sign that the market is worried about retaliatory tariffs, or is it a sign of stock market rotation? This is the internal debate going on in financial markets right now. Nvidia has lost $800 billion in market cap since its peak, but the stock is still double where it was a year ago. So the sell-off in equities and in US equities could be a correction, with markets selling highly valued stocks in favor of more reasonable stocks. It's also rapidly diluting some of the concentration risks that plagued US stock markets in recent years. We'll have to get March data, for example, the US ISM survey reports, before we get a sense of the economic damage that has been done by these tariffs. The US is undoubtedly at risk from retaliatory tariffs, and this could impact the US auto, energy, and aerospace sectors. Tariffs are not a zero-sum game for markets, but for now, the US is in the firing line, although President Trump is calling all of the shots when it comes to global trade. The other main theme dominating markets is geopolitics, and President Trump's announcement that US military aid to Ukraine will be suspended. This has sent shockwaves through markets at the start of this week, but it has galvanized Europe. Europe's defense stocks have surged once more and are at fresh record highs. Trump's showdown in the Oval Office last week with Ukrainian President Zelensky was seen as a major turning point in geopolitics. For now, this is positive for Europe. America's withdrawal from the traditional world order is forcing Europe to boost defense spending far quicker than it otherwise would. There is a sign that Europe can work well together and with the rest of the G7 excluding the US, which could help fuel a much-needed resurgence in Europe. Europe's old-school manufacturing companies, such as Sweden's Saab, BAE Systems in the UK, and Rheinmetall in Germany, are all surging to record highs and are outperforming US tech stocks. Who would have thought that would happen a year ago? For now, the market is pricing in a bad economic outcome from US tariffs, although we will need to assess incoming economic data over the next few weeks to see if this is the case. Also, there are risks for Europe from the US stepping back from Europe and the traditional geopolitical world order. For example, could expensive fiscal policy to boost Europe's defense capabilities lead to high yields down the line and limit ECB rate cuts? This is not the case for now, but bond vigilantes will be watching where the extra defense spending comes from for Europe. Overall, these are unsettling times. Gold is a clear winner and is closing in on the $3,000 per ounce level. Other risk assets could take time to adjust to the new world order created by President Trump. This means March could be a month for volatility. Thanks for joining, and see you next time.